Hi, my name is Natalie Domino, and I would like to thank you for watching our Birkenrode Reports video presentation covering Evolution Petroleum. The other members of our analyst team are Jeff Black, Randall Frost, Seth Hamstead, and Brody Summerall. Evolution is an oil and gas development and production company based out of Houston, Texas. It trades under the ticker symbol EPM. As of March 25th, it was trading at $7.80 with about 28 million shares outstanding, giving it a market cap of $215 million. The employees own a little over 22% of the company, which aligns the employee, management, and shareholder interests. There are about 10 employees at Evolution, so on average, each employee holds just over 2% of the company. We really like that every time these guys make a decision, they realize that it's going to directly affect their own pocketbook. Additionally, another 46% of the shares are held by institutions. Evolution has an enterprise value of $212 million, which is really close to their market cap of $215 million, because Evolution doesn't have any long-term debt. Evolution also holds proved reserves of a little over 12 million barrels of oil equivalent. So here we see the historic stock price for Evolution over the past year. As we can see, it's traded in the range of $4.10 to $8.40 over the last 52 weeks. Here we have a map of the 4 fields in which Evolution operates. Evolution's main fields are the Delhi and Giddings field. We will go into more depth about the Delhi field in a little bit. Evolution is using the Giddings field to test its proprietary horizontal lift technology, which I'll also describe later in this presentation. The Woodford Shale is an unconventional natural gas play where Evolution is still in the testing phase. The Neptune project was another testing field, which they've recently decided to shut in because the production wasn't favorable. Again, these guys own 22% of the company, so they're very judicious with their investments. Recently, Evolution entered into a joint venture with an industry partner to further develop the Giddings field, with 3 wells coming online soon. Okay, so the Delhi field is Evolution's largest current play. Evolution purchased the rights to the field for $2.8 million as a unitized block. The Delhi field is what we think in a perfect location, close to the CO2 reserves of Denbury Resources, an independent oil and gas company, and the Baton Rouge area refineries. In fact, Denbury recognized this and entered into a farm-out agreement with Evolution in 2006. Under this joint development agreement, Denbury paid Evolution $50 million up front, a 7.4% production royalty, and Denbury pays all of the development costs until a $200 million net production revenue point is reached. After this point, the reversionary terms are that Evolution receives 26.5% of the revenue and bears 23.9% of the production costs. Not a bad return on a $2.8 million investment. The first phases of CO2 injection are currently coming online, and new phases are expected to roll out each year after. Here we see our projected cash flows until 2020. With production from the CO2 injections at Delhi coming online now, we project Evolution will begin realizing larger production royalties, resulting in cash flows of close to $10 million in 2012, increasing to about $17 million in 2015 as new phases come online. In 2015, we expect the $200 million reversionary point to be met, and at that point, Evolution will begin to collect increased royalties with very little production costs. Of course, these numbers are heavily dependent on crude oil commodity prices and will fluctuate with those prices. As the price of crude oil goes up, these projections will also go up. Our projections are based on crude oil prices between $90 and $99 per barrel for the next 5 years. We derived our 12-month price target of $14 from a weighted average of discounted cash flow, price to book value, and PE to growth valuation models. We decided to heavily weight the discounted cash flows because we feel this method most accurately reflects Evolution's value. Only the discounted cash flows captures the steep increase in revenues from Delhi and the effect of the reversion of revenues and operating costs from Denbury Resources to Evolution. The PEG method uses the 5-year expected earnings growth rate as the price to earnings multiplier for evaluation. While this does recognize Evolution's steep growth in production over the next 5 years, it does not place any value on the dramatic increase in revenues after the reversionary interest is realized. In creating the price to book value model, we used Evolution's current ratio as the 1-year multiple. Other methodologies using peer groups weren't considered, as evolution's capital structure and operations are relatively unique in the industry and therefore make comparisons rather meaningless. This leads us to some potential upsides we see in evolution that we couldn't value in our models. As we mentioned earlier, evolution is currently developing a patent-pending artificial lift technology that it's testing in the Giddings field. Evolution has successfully tested the system in the Giddings field as a proof of concept in the hopes of attracting other developers to adopt the technology. Evolution does not want to get into the oil services business, so they're hoping to license the technology or spin off the technology into an independent operation. Now, whether or not developers will adopt the technology or Evolution can successfully spin off or license the technology is difficult to predict or value, so we left it out of our valuation. We also feel that Evolution is poised to be an acquisition candidate. The fact that Evolution has no debt and has significant amount of production coming online in the near future makes them really attractive. Management is very aware of this and believes that this will happen in the next few years. In fact, when we asked management where they thought they would be in the next 3 years, one of them replied that they'd be fly fishing. To better position the company for buyout, management plans to diligently reinvest cash flows from the Delhi field into Evolution's other current projects or future projects if they become available to build the value of Evolution's resources. This means that shareholders will receive the full value of the cash flows plus additional value generated by the projects in the event of a buyout. Well, that concludes our presentation on Evolution. We feel this company has a lot of potential and that it's well worth taking a closer look. It's truly one of the hidden gems Breckenridge Reports manages to find. Thank you for taking this time with us. The Breckenridge Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.